Hello, and welcome to this week's edition of Safe Money Mindset, the show dedicated to helping you defend your wealth. I'm your host, Kristen Oakley, and joining me in the studio, we have two members from Quest Commonwealth. We have Jeff Perry, he is the co-owner, and Rick Williams, senior retirement planner. We recently did an episode all about talking about financial education, and one of the hot topics that we know a lot of folks have questions about are taxes and how can you lower your tax burden in retirement. So if you would like to learn more about that, you're definitely not going to want to miss today's show. Jeff and Rick, it's great to be back with you. Good to see you.
Great to be here. We're excited.
Yeah, absolutely, and I love the topic. Can't wait.
I think we all do. I think everyone is a fan of paying less to the IRS, right?
Yeah,
exactly. Legally.
Legally, yes. We want you to not have to pay any more than you are legally required to pay. And so that's what we're going to be talking about today, a very important tax saving strategy. There's something known as a Roth conversion, and that term gets thrown around a lot, but I think a lot of people don't necessarily understand it. There's a lot of misconceptions. So we're going to talk about Roth conversions today. 5 reasons why you want to make sure that you engage in a Roth conversion strategy. So let's get to it.
Well, great. And as you stated, Kristen, it's a hot topic. We get a lot of questions on Roth IRA conversions, and we get a lot of people that come in that have done them with other advisors that maybe it wasn't the right time. So we decided to dedicate this entire show to that, and it's a strategy that can offer significant advantages when you're in retirement, pre-retirement. And we're going to come up with 5 main reasons today why you might want to consider a Roth conversion for your retirement.
Let's just start with the bare bone basics of what a Roth conversion actually is. What does that mean for someone to do a Roth conversion?
Well, it's basically taking a taxable investment and making it a non-taxable investment. So it's doing that conversion, paying the taxes on the seed, and then not having to pay the taxes on the crop.
On the harvest, right?
Yes,
for sure.
exactly.
Yep. So the majority of Americans have the bulk of their wealth saved up in something like a 401k, a 403b, all these different types of tax-deferred accounts, traditional IRAs. And so what we're talking about is moving that kind of money over to a Roth account. Because I think a lot of people hear the term Roth and they immediately assume that they can't contribute to a Roth account, maybe based on their earnings, right?
Sure. So when you think about a Roth IRA, first of all, let's talk about what it is, because you might be hearing this for the first time. So a Roth IRA, we're talking about a retirement account. So you hear IRA in there, so individual retirement account. So it's still an IRA, but it's a special kind of IRA. A traditional IRA or other types of tax-deferred accounts like 401ks or 403bs, these are all, you make a contribution to it, and that contribution is tax-deferred. The growth on that investment is also tax deferred, meaning that you don't pay tax. You're kicking the tax obligation down the road to future self, right? Future you is going to deal with that. So what a Roth is you're going to pay taxes on what you put in there now, but the growth is going to be tax-free. This is very, very rare in investing because even in a traditional investment account, like a traditional brokerage account, if someone just took money out of their checking account and invested in a company and that company did well and the stock went up, they're gonna pay something called capital gains on the growth, right? So there's very, very few types of accounts where you're not gonna pay that. So Roth, yes, you're gonna have to pay on the money you put in, and I'm using that term very carefully because the money you put in can be put in one of 2 different ways. Contribution or conversion. In contribution, there's all kinds of rules around it. You have to be working, you have to have earned income, you can't make too much money. There's all kinds of things.
There's a certain amount you have to, like a limit to
There's
put
a limit
in.
on how much you can actually contribute. All these different contribution rules. So today we're talking about conversions, meaning taking money that's in a tax-deferred vehicle, like an IRA or 401k, and putting it in a Roth IRA. You will have to pay taxes on that conversion amount. But from that moment forward, anything you earn in there is tax-free. So what that means is later on in life, when you're taking money out of that account, you're not going to pay taxes on it. And it doesn't affect anything like your Social Security or your overall estate tax and things like that. It's just kind of like a pool of cash that's growing.
Right. It's a very important strategy to understand, and this, I think affects more people than they realize because, again, as we stated, most people have the bulk of their wealth saved up in these tax-deferred vehicles. It's always so sad to me when I hear someone say, oh, great, I've got $1 million, let's say, saved up for retirement, right, in these tax-deferred accounts. Well, not all that money is yours. Unfortunately, you have a partner in that account, whether you realize it or not. That partner is Uncle Sam, and the time is coming when you're going to have to pay tax on that money. And so that can significantly reduce how much is in the account.
Yeah, the IRS hasn't forgotten about that money, even if you have for the time being.
Right.
They know it's there and they're counting on it. Okay, so you're going to have to pay taxes, and they will force you, once you get into your mid-70s and beyond, to pay a certain amount. They'll force you to take money out even if you don't need that money. So there's one of the ways to avoid that is Roth, because Roths don't have required minimum distributions.
Right.
But there are 5 main reasons. I tell people all the time, they're like, should I do a Roth conversion? I'm like, well, let's go through the 5 reasons.
Yeah.
And then if one of those reasons resonates with you, then you probably should.
So let's do it. So what is reason number 1 on the top 5 list?
Well, the number 1 reason is people want to save taxes in their own lifetime, right? And so that's what we've been talking about right now, is that, I've been saving taxes by deferring my contribution, and then I'm going to retire, and my taxes are going to be real low, and everything's going to be great. Then all of a sudden, I'm going to turn 73 or 75, depending on when you're born, and then the RMDs kick in, and your taxes are going to go up. And I've seen people in their 70s and in their 80s paying more in taxes than they ever did while they were in their working. So,
which is so sad, because this was sold to us as a good thing, right? Put money away in these tax-deferred accounts now, get the tax break now. Supposedly in retirement, we were all supposed to be in a lower tax bracket, but that's not really happening.
Well, it is if you only look at the first year of retirement, right? Which is what everyone's doing. So all the people that give that advice, they're like, these are the highest taxed years you're ever going to be when you're working, right? And well, it is depending on how much you've tax deferred. So then say you retire at 64, or let's just say, whatever, 65, you retire. Yeah, your tax bracket's going to go way down because you're not going to pay into your income, you're not going to pay into FICA, which is Social Security or Medicare. So yes, your taxes go way down. So, but then by the time you get your mid-70s, the RMDs kick in on all that deferred tax, and your taxes go way up. So if you look at it from a lifetime, okay, and I'm talking about in a situation where the tax laws remain exactly the same. I'm not even saying, well, the taxes might be higher. What's Washington going to do? What's Congress going to do, right? I'm talking about even if the taxes were the same, and we model that out, it's likely if you've tax deferred $500,000, $1 million more, you are going to pay more later on. So it's possible by doing conversions, doing them strategically in your lower tax years, okay, doing them strategically and looking at them 1 year at a time, it's possible to lower your tax obligation in the future and look at your overall taxes, cumulative taxes, it could be lower. That's reason number 1. That's the reason everyone's thinking about, but there's 4 more.
Yes, and we're going to get to all of those. But if someone's watching today, maybe this is newer information to them, and they're going, oh my gosh, I didn't even know there was a way to lower my tax burden in retirement. What would you say to that individual?
I would say, well, let us show you how to do it, right? Let's find out if this is good for you, right? I know someone that just went and came and met with us, and he said, I converted $1.5 million into a Roth IRA in 1 year. And I said, holy smokes, let's do the math on it now and find out what's going to happen. The good news is that money is going to be growing tax deferred from that moment on. The bad news is you are in the highest possible tax bracket you've ever been in, right?
Yeah.
So there's all
kinds. Because he did it all at once versus strategically doing it.
I also had someone that came in, they had just retired, they were 63 and they wanted to convert $30,000. And I said, well, where are you getting your health care from? And they said, well, I'm getting it from, the marketplace, the Affordable Care Act. And I said, well, are you getting subsidies? Is it getting discounts? And they said, yeah. And I said, well, let's go back to the insurance person that sold you this and see if $30,000 more of income is going to increase how much you pay. And absolutely. So there's all kinds of things like that. So when you want an expert taking a look at that, taking a look at your tax situation, give Quest a call. We have people standing by right now to take your call. The consultation is complimentary. There's no cost to the financial analysis. There's no cost to the tax analysis. And for a gift, you can claim your book, Safe Money Mindset, my new book that's just come out. This is your roadmap to a safe retirement. We'll give this to you whether you become a client or not. And that's it.
Wonderful. Well, I know we have a lot more to get into. This is going to be continuing to be a great conversation. So Rick, Jeff, thank you so much. To our viewers at home, we realize that we're bringing up some things today that you might have questions about. It might be piquing your curiosity. Well, again, for no cost, no charge, no obligation, this is simply an invitation to have a conversation to see how Quest Commonwealth can help and serve you. If you would like to be able to come in and meet with the team and receive your complimentary written financial plan, all you need to do is call that number on the bottom of your screen, 888-959-4830. Or if you'd rather not talk to someone right now, but you do have your smartphone handy, if you simply pull it out, you can open up that camera app, point, click, and scan that QR code down in the bottom right-hand corner of the screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team will reach out to connect with you to schedule your complimentary visit that way as well. Don't go anywhere. When we come back, we're going to dive into the remaining 4 top reasons why you should be considering a Roth conversion. Stay with us.
I became a financial advisor back in 1979. That's when I entered the industry. And I've seen a lot of changes over the last 40 years. And at this current point in my career, I would say that I'm more of a retirement specialist and a distribution advisor. You know, it takes a long time to build up your assets and to plan for retirement, but when you're in retirement, you really don't need an accumulation advisor. That was the previous phase of your life. You need now a distribution advisor that's going to help you navigate the years ahead in your retirement. The thing that brings me reward is seeing the client experience relief, knowing they can retire. They have sufficient assets to be able to retire and not have to worry about running out of money at some stage in their life. We do make tweaks. If that's not the case, we'll advise. That's what we are, advisors. We'll advise them that some changes or tweaks need to be made so that their assets can last. But I think that's number one, is seeing a person experience that relief that they can make that transition to retirement. And number two, helping people achieve that is what really brings me reward and satisfaction.
Well, welcome back. You're watching Safe Money Mindset, the show dedicated to helping you defend your hard-earned wealth. I'm your host, Kristen Oakley, here with both Jeff Perry and Rick Williams from Quest Commonwealth. And we are talking today about the 5 reasons why you might want to consider doing a Roth conversion. I want to correct something I said right before the break. I said 5 reasons why you should. It's not always in everyone's best interest to do this strategy, but for a lot of folks, it might be. And this is why we're having this important conversation today. And we'll also talk about later on in the show who it might not be a good fit for. But considering that for a lot of folks, this is the right way to go, let's talk about the next reason that someone should consider it.
Yeah, I mean, just right before that last break, I had one that it wasn't necessarily good for because of her healthcare situation, the cost of it, right?
Yep.
But the other reason, we talked about saving money in your lifetime, and that's great, right? So those of you that are married out there, okay, those of you, you have all this tax deferred money that you saved in 401ks, and you know we've talked about the RMDs that are going to kick in, and the IRS is going to come and they're going to tell you have to take this much out, you know, and then if you both passed away at the same time, you and your spouse, that would be a tragic accident, correct? I mean, that's normally someone survives the other. Well, what happens is you're married, you're filing as married jointly, okay? Somebody passes away, the surviving spouse is now going to file as single. And so you think you can lower your expenses, but the IRS is not going to let you lower your expenses because of RMDs. So now the expenses remain the same, okay? But now you're filing single. So think about this. If you have an adjusted gross income of $60,000 and you're filing married, you're going to pay about 12% tax bracket. But if you're single, that exact same amount of money is 22% tax bracket. So you just put your spouse in that tax bracket. If you had that in a Roth, or at least some of it in a Roth, right? Again, no RMDs, no taxes on that money. So now you've set up your spouse not to be hit with all these single. That's the next. That's the next thing. Is setting up your spouse.
Right, for sure. And we also need to talk about what if you're a single person, right? Because that presents its own set of challenges. So talk about how the Roth conversion can come into play there.
Well, that's actually point number 3. And prior to 2019, a non-spouse beneficiary IRA was able to continue over that person's lifetime. Where now, as of 2020, there was the Secure Act that came out. And now a non-spousal beneficiary, they have to spend that money in 10 years. So take that example, $500,000 IRA, non-spousal beneficiary, that would be $50,000 a year if you took it out over the 10 years. That would increase your income because that's treated as ordinary income at that point. So it's going to increase your income, or the beneficiary's income, by $50,000 a year. With Roth, that doesn't come into play.
We actually have 2 newer clients that are brothers that each one of them inherited $850,000, all of it IRA. So we have to come up with a very advanced...
In traditional IRA.
Yeah, traditional IRA, traditional, right? So we had to come up with a very advanced plan, to spend that down, because if you do what the IRS makes you take out of an inherited IRA, in that 10th year, we calculated they were going to have about $500,000 still left.
Wow, yeah.
You know, at the end of the 10 years. So that means they would have had to take out that $500,000 in 1 year and be taxed all in 1 year.
So much would be wiped out from taxes.
Of course, you'd be taxed on the highest, like you're a millionaire. You're taxed like you're a millionaire.
Yeah.
You know, and so we came up with a strategy for both of them to convert over a period of time and
That's
different
so
things.
important. And to your point too, you know, a lot of times when beneficiaries are receiving this kind of inheritance in this case, you're in your higher earning years. And so then you have this money that you have to take out. Now that puts you into a significantly higher tax bracket. It can really wreak havoc on someone during that time of their lives.
100%.
Yeah. All right.
100%.
Well,
and they don't get the advice for having that as a tax planning event for themselves.
right. Yeah. And this is why it's so important to be having this conversation. So we're on to rule number 4, or basically reason number 4,
Reason
right?
4, so we covered tax savings in your lifetime, tax savings for your spouse if you're married, tax savings for your beneficiaries after you're gone.
Yep.
So here's the other thing. Let's go back to your lifetime again. Reason number 4 is, you know, later on in life, you might have a high expense. Something might happen. You might have a healthcare expense, or maybe it's not a sudden emergency expense. Maybe it's you just want to do something. Maybe you want to buy that Corvette you always wanted, or you want to take the whole family on vacation. You just figured out, hey, the only way I'm going to be able to spend time with the grandkids if I take them all to Disneyland. And so you're going to take this big chunk of money out of your tax deferred account. It's going to increase your taxation for that year like crazy. If that's a Roth account, you can take that out and not worry about it. So it's this cash-free account that you can do whatever you want and spend it on whatever you like. Unlike other types of tax-free accounts, like, you know, stuff for education or stuff for healthcare that forces you to spend it on education or to spend it on healthcare, you can spend Roth IRA money on gummy worms if you wanted to. It doesn't matter what you spend it on, right?
Oh my gosh.
So, and it's not going to be taxed, right? And the IRS doesn't care about it. So that's the 4th reason, is just you have this emergency fund for yourself.
Again, so many key factors that come into play, but it's not right for everybody, right? So who would a Roth conversion not be the right choice for?
Yeah, so like for me right now, probably, you know, I'm at some of my highest years. I'm going to be 50 years old. I'm under 59 and a half.
Right.
So if I tried to convert from my IRA to a Roth IRA and I tried to pay the taxes from that conversion, I would be penalized on that amount of money that I took out. So for instance, say I converted $10,000 and I was in 20% tax bracket. And I go, no problem, let's take $8,000 of it and put it in my Roth, and the other $2,000, let's just send that to the IRS. Well, the IRS is going, well, you just took a distribution, my friend. A $2,000 distribution. You're not only going to pay tax, you're going to pay a penalty on that $2,000.
Right.
So I can convert 10,000, but then I would have to take the taxes out of another account, like my checking account. So you got to pay attention to that. The other reason why I'm not great, I'm already taxed like crazy.
Yeah.
You know what I'm saying? So I'm just going to add more income. Now, if I wanted to convert, for me, what I would do, I would look and say, what top tax bracket am I touching right now? Am I at the top of that tax bracket, or am I barely touching it? If I'm barely touching it, maybe I can convert a little bit on top of that. So age comes into play, your income comes into play, and things like that. And what we do is we meet with our clients every year, the ones that are doing it, and we look exactly, and we say, this year, this is the amount. Last year it might have been more, might have been less. And then we also look at what's going on with the tax laws.
Right. But it's definitely not something that you want to do all at once.
Oh,
Like,
gosh, no.
Right?
Not at all.
Gosh, no.
Not at all.
Gosh, no.
Well, and when is the ideal time then? If someone's watching the show and maybe nearing retirement, I mean, is there a certain sweet spot where this is the time to start planning and executing those
Kristen,
Roth
you're setting me up. There is a perfect time for this, right? So I talked about it earlier. The moment you retire, your taxes are going to go way down, because if you're collecting Social Security at that time, if you are, it's barely taxed. But even if you're drawing income off of an IRA or something like that, you're not paying into Social Security, Medicare, so your taxation is much lower. So your taxes might have been right here. You retire, you're in your 60s, they're going to go like this, then it's going to keep going, and then RMDs kick in, it's going like that. So that little window right there, after you retire and before RMDs, is the perfect conversion, because you're in a low tax bracket. And if that's you, you might want to give us a call so we can build that out for you. We can analyze it, we can model it out into the future. Tax planning is part of the overall financial analysis that we build complimentary at our no-cost consultation. So give us a call, schedule a consultation, and we'll go through that with you. And also, I'm going to give you the roadmap. This is the book that I just wrote. Had some contributions from our founder, Gene Whitstock, and you'll get this by coming and seeing us.
Wonderful. Jeff, Rick, thank you so much. To
you.
our viewers at home, again, that number to call to receive your complimentary written financial plan is there on the bottom of your screen. Simply call 888-959-4830, or you're also welcome to scan that QR code, and that will get you connected to the team of Quest Commonwealth as well. Stay with us. When we come back, they're going to reveal the number 5, the 5 reasons, right? Gosh, I'm getting a little tongue-tied here. The top 5 reasons is what we're going through on why considering a Roth conversion might be right for you. Stay with us for reason number 5.
The importance of having a good plan going into retirement is, first off, just that knowledge that your money's going to be there when you're in your 80s and 90s.
A lot of people are out there just saving and accumulating, and they just say, have I saved enough? And once you get into retirement and they start thinking, okay, I'm going to start drawing off that account, and then what? Like, how long is this account going to last?
A person really needs a financial advisor to assist them, to help them. We have people that were do-it-yourselfers, and they have hired us because they've reached that critical stage in their life where they recognize, I can't keep doing this, I don't have all the knowledge. Again, that's where our team approach comes in helping them to look at aspects that maybe they didn't think of.
To be able to continue to serve the public and continue to understand that I'm making a difference, it's very important to me.
Welcome back to Safe Money Mindset. I'm your host, Kristen Oakley, here with both Jeff Perry and Rick Williams from Quest Commonwealth. We are working through today the top 5 reasons why you may want to consider engaging in a Roth conversion strategy. We've unpacked the first 4 reasons. We had it's for personal tax savings, obviously, spouse support, for your beneficiaries, for even emergency expenses. So what is the 5th and final reason?
Well, it's simple. It's peace of mind. Just think about all those other 4 reasons. You have that all lined up, right? Even if you didn't save taxes in your own lifetime, knowing that you've taken care of your spouse, or maybe you've taken care of your children, or you've created that emergency fund for yourself for expenses or for your family down the road, because it's also when they inherit that, there's no taxation on that, no taxation on the estate. It doesn't even increase your overall estate tax, okay? It's not even counted towards that. And so it's that peace of mind knowing that this is just taken care of, knowing I'm taking steps right now to save that much money, okay, where you've tax deferred that much money, you've obviously sacrificed, in the past to do that. And you set your future self up. You're not done doing that yet. Just because you've retired and maybe you're in your 60s, you're not done. You're probably you got another 20, 30 years, if statistics are correct. So you have to still consider your future self, and you still have to set them up for success. And it's the peace of mind. So you've done it for yourself, you've done it for your family, you've got your emergency fund, everything's all set. And the last thing is, think about Washington, D.C. We already know that taxes are due to go up back to 2016 levels in a couple of years. That's going to happen unless Washington does something. So if you're sitting there for 20 years in retirement, and depending on who's in D.C., who's in Congress, or what's going to happen with your income taxes, imagine you going, I don't care what they raise taxes, it doesn't affect me. I mean, you might worry about the country a little bit, and that's great. It's altruistic of you, but your own personal taxation, you're sitting there going, whatever they decide, it doesn't affect me because I've taken the government out of my plan.
Right. He's no longer a managing partner in my IRA, in my 401k, right?
100%.
Well, how straightforward is the process? If someone's watching and they want to engage in this Roth conversion strategy, what is that going to look like?
Well, starting is very simple. You must schedule a consultation with Quest Commonwealth. Because during our meeting, we're going to listen to you. We're going to understand all the things that Jeff had brought up for the obstacles or, the reasons why to do a Roth conversion. And we're going to listen to your specific goals. So then we'll design that plan, that retirement plan, no cost, of course, and we're going to show you what the tax savings is going to look like at each year if we do the specific amount that we're suggesting, looking at all the aspects that we had talked about earlier. Because a lot of times people come in, like Jeff had stated, somebody was just told, hey, just go ahead and do a Roth conversion, but the person that advised them of that never looked at anything else.
Yeah, we have a couple that I met with I don't think it was then, last year, it was the year before that, but they came in, they had the number in their head, and they said, hey, I want to convert 150,000 this year. And I said, oh, we already know what it's going to do to our taxes. We've done the math. They were very astute. And I said, okay, did it? I go, this is going to be your overall tax bracket. This is what you're going to end up paying for this conversion. They said, yes, I'm good. I'm like, one other little thing I want to check is let's just see. I go, you're both on Medicare. I go, let's just see what's going to happen to your IRMA bracket,
Yes,
right?
talk about that, yeah.
So, you understand that Medicare, once you turn 65, Medicare is going to be the health care plan, okay? And Part A and Part B are provided by the government, okay? But it's not free. So there's a cost to Part B. And how much you're going to pay for that is based on your income. It's income driven. And remember, like Rick said earlier, any income you're taking out of one of these tax deferred accounts, IRAs, 401ks, that is taxed as income. So it counts towards income when calculating how much taxes on your Social Security, stuff like your Medicare. And so how much your Medicare. So in that example, I said, okay, guys, you're going to go up 2 IRMA brackets on your Medicare. Are you comfortable with that? And they said, ugh. And I said, I don't want, I didn't think about that. And they said, okay, we're comfortable with going up 1 bracket because we believe that the tax savings down the road will eclipse the amount we're going to pay extra on the Medicare. We believe that. And we've modeled that out. It's not guesswork. We did the math and modeled it out, right? So they go, but I just don't like it. I don't like the feeling I have going up 2 brackets. And they go, how much can we convert and only go up 1 bracket? Did the math and said 130,000. They go, let's do it. And so that's what we did. So it's not willy-nilly. It's not like, hey, let's 12,000, 50,000, whatever. It's not, let's see what happens, right? Yep. We have some of the most sophisticated software and modeling software out there. And we actually, for Roth conversions, we use 2 different ones. Okay, we use Tax Clarity and we use Retirement Analyzer. All right, and I'm just throwing that out there. So that's what we use. We start with that so we can actually model out what your taxes are going to look like. And we typically do that with our clients somewhere in October or November because we already have like 10 months of income on that year. We can guesstimate the next 2 months. And we can actually do your tax return in November and figure out where you're going to be at in your overall tax bracket. And then we can say what will now happen if we convert. Then we can take that information, put it in the Retire Analyzer and model that out and say, hey, okay, so if you do this and we do this, blah, 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 we do this every year, then this is how much tax savings you're going to have. This is what, if you pass away at 85, this is what's going to be tax-free. If you pass away at 90, this is what's going to be tax-free. And we can go through all that.
And the key there, what Jeff just stated, is it's a holistic view. We're looking at everything. Everything that we talked about during this show, we're looking at it all. And then we're going to make a recommendation for you.
Well, we say this on the show all the time. How you make a decision in one area of your financial life can and will affect all the others. That's why you can't look at any of these important decisions in a silo. You have to see, just like you shared in that example, how it's going to impact your Medicare, how it's going to impact your Social Security getting taxed. I mean, there's so many things that come into play. So this is why it's so important to engage in that from a comprehensive perspective.
Yeah, think about if you wanted to do this, right? How many different people you're going to have to call up and talk to. And are you telling me an accountant's going to talk to an advisor, which is going to, it's never going to happen. So we've put all of this under one roof. And we have the experts in place. So give Quest Commonwealth a call, and we'll put together this plan for you. And in order to get the taxes, we're going to have to do a full retirement analysis. So you're actually going to see what your retirement looks like too, on top of the taxes. And then also by showing up, we'll give you the book. It's the roadmap to your safe retirement, and I know you'll find value in it.
Wonderful. Jeff, Rick, thank you so much. To our viewers at home, thank you so much for joining us this week on Safe Money Mindset. Again, that number to call to claim your complimentary written financial plan, 888-959-4830, or you're also welcome to scan that QR code. We appreciate you being here. We look forward to being back with you next time on Safe Money Mindset.